Hi, I'm Louisa Sijabat, a liquidator and bankruptcy trustee. So today's question is from an accountant, and it actually had many parts to it. I'm just going to address one part of that in this video. So there's a head company, which is just a holding company, and a subsidiary operational company. The head company has loaned about $10 million to the subsidiary company, and it's secured by a floating charge, which is also known as a non-circulating security asset. If there's any risk to the operational company, can the head company get its loan repaid before any liquidation or any sort of risk? And if the operational company was to go into liquidation, could the liquidators claw back that repayment? So, can a subsidiary repay a secured loan to a head company? Yes, and that could be in the normal course of its business. One of the things to bear in mind is that the directors of the subsidiary company need to also have some thought that they owe duties to the subsidiary company separately to the duties they may owe to the head company if they're a director of both. So they must always act in the interests of each company that they're a director of, not just one company at the expense of another. So if they do think it's in the best interest of the subsidiary company to repay this loan, or it has to repay it according to the terms of the loan, or it gets called on, depending on what the terms of the loan are. But in any case, it is able to do a repayment of the loan as long as that's within the terms and conditions and general fiduciary duties and statutory duties of the director. Now, if the operational company were to subsequently go into liquidation, could that be clawed back by the liquidators? Now, the accountant is probably referring to something called unfair preference payments, which is where, in certain circumstances, when a company goes into liquidation, it can claw back money that the company had previously paid out prior to its liquidation. Now, one of the criteria to be an unfair preference payment is that it's a repayment or payment of an unsecured debt. Now, what's been described in the scenario, though, is a secured debt. This is, of course, based on the assumption that all the security documentation is properly in place and that it's been properly recorded and registered on the PPSR, which is the Personal Property Security Register. So they're two very important things to check. Now, if it is a repayment of a secured loan, it cannot fall into the category of being an unfair preference payment, and so it cannot be clawed back in that way.